really get its legs, we have to have three things happen. First, the next generation vehicle has to start to ramp, or people have to gain confidence that it's going to ramp and be successful. Second, their margins need to go up, and the most likely lever for that happening is the increase of FSD, full self-driving penetration, which leverages the AI that they've built, in addition to volumes starting to pick back up. And third, it's continuation in growth, really good growth in their energy storage business. So when you talk about leveraging this R&D that they've spent a lot on, it's two real products that come out of that, the big spending. It's number one, that next generation vehicle, which we think should start production in the second half of 2025, and continued FSD penetration. Now, we think that the FSD offering from the company at $12,000 currently is a little too rich, particularly relative to the cost of the vehicle. We think the company should cut the price of that FSD to really increase penetration and really have the margins start to turn in. If you think about it, that offering is about 100% gross margin, very, very high gross margin because it's a software upgrade.
If you were asked what you think about Tesla becoming a part of the Magnificent Seven, what would your answer be? Take a moment to think about it. At the time of this video, Tesla is the Magnificent Seven's biggest laggard to date. And it's not the only one. Shares of some of the Magnificent Seven members like Apple and Alphabet have also been in the red since the start of the year. But could it be the end for Tesla, or is the automaker able to maintain its position as a member of the Magnificent Seven? Let's find out.
Musk on Tesla, he said basically a few weeks ago there's going to be macroeconomic challenges. Those are going to impact Tesla over the next 12 months. But however, I would not bet against Batman. Musk is a superhero. And long term, there's huge demand for that new truck they have. I might get one. And so I see lots of good things happening in Tesla. They could be the best AI play out there once they master autonomous driving in its full capacity and it gets to its final plateau where we can just really sit there and keep our hand on the wheel and not pay much attention.
Yeah. You mentioned, obviously, that truck and liking that Cybertruck. The AI 5, right? So NVIDIA, which is part of the 7, but NVIDIA, Microsoft, Taiwan Semi, Broadcom, and AMD. Where do those fit in, and do you like all of those because they're part of the AI craze?
I do like all of those, and even Dell got sucked into the AI craze with their actual last quarter when they had incredible server sales for AI. And there's lots of money being spent by all these companies, and so revenues are going to increase. The AI 5 is a great play right now for the next 3 to 5 years. You definitely want to own those stocks. That's where the market will grow. Those stocks will lead the market, and the rest of the market will get carried based on those stocks, just like NVIDIA has risen the market up this year, 7%. It's not the actual market growing, it's the leaders raising the market up, and that trend will continue as we get into a very different economic landscape, both demographically and economically, because we still see credit tightening, we still see more people leaving the workplace than entering it, and we still see interest rates being higher for longer, as we think we're going to be in a higher inflationary environment for quite some time, due to the fact that the global concert of central banks and countries are spending way more money than they collect. It's not so much the consumer as it is the concert of government and federalized spending domestically and nationally that's causing this excessive inflationary effect. I think that 2% inflation by the Fed as a benchmark is a pipe dream. Can we be there in 6 months? Probably. 6 months to 9 months, somewhere in there. Will it stay at 2%? Probably not.
Not so long ago, Tesla had $1 trillion valuation and was a part of a tiny but exclusive club of companies that had broken through the threshold. However, there are just 3 companies that have remained consistent and constant in this group, and they include Apple, Microsoft, and Alphabet. In 2021, Tesla earned a spot on this list, with the automaker making a market cap surpass the $1 trillion mark for the first time, thanks to rising share prices that followed strong earnings and news that Hertz would be buying several $1 billion worth of Tesla cars. Reacting to the milestone was a big achievement for Tesla, placing it in the elite group of companies that was shaking the world. Although at the time Tesla was still in the shadow of Apple's and Microsoft's $2 trillion plus market caps, the company's share price hit the $1,036.63 mark before settling at just under $1,025 at market close for a valuation of $1.01 trillion. But this surge wasn't for long. Despite the meteoric rise in Tesla's stock price, the stock fell pretty hard, losing nearly 60% of its value and eventually had a valuation sink to around $927 billion. However, while Tesla's valuation may have fallen drastically, there are some possibilities that the company could reach the $1 trillion valuation point again. In fact, a seasoned analyst just revealed how Tesla could find its way back to a strong place as a member of the Magnificent Seven. But will this happen? Let's find out.
Tesla is the Magnificent Seven's biggest laggard year to date, but it's not the only one. Shares of Apple and Alphabet are also in the red since the start of the year. Now this week, we are focusing on these three laggards and what it's going to take for the companies to turn things around. Today, the focus is Tesla, currently trading just around $179 a share, a loss of nearly 30% this year alone. Our next guest, though, say that now could be a good buying opportunity. For more on that and what the catalyst will be, we want to bring in George Generikis. He's with Canaccord Genuity's managing director there. George, it's great to see you. So talk to us about why you think Tesla is a buy at these levels.
Well, first, let's address the reason why it's lagged. And it's pretty simple. The numbers have come down. I mean, if you look at the earnings revisions for the last 12 plus months, they've been terrible. I mean, I think we started for 2023 somewhere early in that year on $6, and it came all the way down to $3. And I think we're at a period of time right now where the worries likely exceed the reality. And we had some numbers last week come out of China that weren't very good, but those people didn't take into account that the new year has been pushed into February. Also, some stuff that happened in Germany. Their plant came down for about a week because of arson, a week plus. And in the U.S., people are worried about the production of their new Model 3. And we think that the best way to kind of gauge, for the most part, what's happening with Tesla, particularly in the U.S., is to look at their prices. And they've been pretty stable in the U.S. over the last few months. So there's a lot of wood to chop still in the quarter, but in the near term, we think that we may have overcorrected here to the downside.
They talked on their most recent earnings call, George, about the spending and some of the record R&D that they had done during 2023, which now places a lot of emphasis on bringing that to fruition in 2024 and years following now. How much of that spending do you anticipate will lean further towards the side of this artificial intelligence narrative that has started to prevail with Tesla, even though we've seen some early slippage this year, at least in the price action?
Look, we're in a little bit of a pause period right now for the stock. In the near term wiggles, we think we've overcorrected, but for the stock to really get its legs, we have to have three things happen. First, the next generation vehicle has to start to ramp, or people have to gain confidence that it's going to ramp and be successful. Second, their margins need to go up. And the most likely lever for that happening is the increase of FSD, full self-driving penetration, which leverages the AI that they've built, in addition to volumes starting to pick back up. And third, it's continuation in growth, really good growth in their energy storage business. So when you talk about leveraging this R&D that they've spent a lot on, it's two real products that come out of that, the big spending. It's number one, that next generation vehicle, which we think should start production in the second half of 2025, and continued FSD penetration. Now, we think that the FSD offering from the company at $12,000 currently is a little too rich, particularly relative to the cost of the vehicle. We think the company should cut the price of that FSD to really increase penetration and really have the margins start to turn in. If you think about it, that offering is about 100% gross margin, very, very high gross margin because it's a software upgrade.
Canaccord Genuity LLC Managing Director George Gianarikas recently disclosed in an interview on Yahoo Finance how Tesla could turn its lagging performance around and remain a worthwhile opportunity for investors. George noted that for Tesla stock to experience a turnaround, several developments must emerge from the automaker's record research and development spending. The analyst also revealed that these developments might form the basis for Tesla to solidify its position in the Magnificent Seven. Hey guys, welcome back to Tesla Tomorrow. Based on the analyst's comments, Tesla needs to do just three things to return to its position. First up, the next generation vehicle has to start to ramp up, or people are going to gain confidence that it's going to ramp up and be successful. Second, the company's margins need to go up, and the most likely lever for this happening is the increase of FSD penetration, which leverages the AI Tesla built. in addition to volume starting to pick up. And third is the continuation in growth of Tesla's energy storage business. Now you'll agree that all these factors are actively being worked on by Tesla, and they are close to becoming a reality, which means one thing, that Tesla will soon become a trillion-dollar company again. Remember when Elon Musk said that the value of Tesla was the primary focus of a number of different things related to autonomy? Well, we're going to see this in actual numbers. As the CEO once said, the short-term variances in Tesla's gross margins and profitability are actually relatively minor in the long term. And according to him, autonomy will make all other Tesla numbers look silly. To understand what he's trying to say, let's explore an interesting Tesla valuation model and see what could potentially lie ahead for anyone who's investing in Tesla stock. But before we do, if you like this type of content, hit that like button, subscribe and turn on post notifications to keep up to date on everything going on with Tesla. This valuation model is focused on a conceived estimate of Tesla's robotaxi network. In fact, it assumes that Tesla sells its vehicles at cost price and only makes money from FSD subscriptions and robotaxis. This means that including all other revenue from energy, insurance, supercharging, service, dojo, and bots, Tesla will only make money from FSD and autonomy. So let's say the Tesla company sells a cumulative of 130 million vehicles by the end of 2035, and these vehicles actually form a robotaxi fleet for the company. For this model, Tesla would need to make up to $300 billion in revenue from FSD by 2035 and about $580 billion as FSD autonomy revenue in the same year, meaning that the combined annual FSD and autonomy revenue by 2035 could expand to $895 billion. Applying a net profit margin of 35% and an earnings multiple of 30 to these revenue figures gives a possible market cap of $9.4 trillion for Tesla in 2035, and that is just 11 years from now. So what if we factor in revenue from Tesla's energy business alone? Think how big this could be for the company.
I have seen, though, the price wars play out. Obviously, Tesla, far from the only automaker, one of many, I should say, that has been forced to lower the prices, obviously putting pressures on margins, very similar to what you were just saying. How do you see that, more broadly speaking, beyond Tesla, shaking out just a bit, and that pressure to the downside in terms of boosting demand? How much longer are they going to be forced to slash prices in order to drive the demand that we simply have not seen?
Well, look, there's been a pause, like I said, recently, particularly in the US. The price declines that we saw for the most part in 2023 is sort of ebbed right now, which for us is an indication that maybe things aren't that bad. And what the company did strategically by being that aggressive is, first of all, they get to sell more vehicles, right? Because interest rates went up and most people financed the purchase of their vehicles. So that meant that the prices of vehicles went up artificially. But second, it put a lot of their competitors on their back legs. I mean, margins got a lot worse for some of the pure play EV competitors. Sales got a lot worse for them. And even for the traditional OEMs that try to compete against Tesla, their margins got significantly worse because they couldn't compete with Tesla on price. So what we saw is, longer term, what Tesla did is put a lot of its competition on the back foot, particularly in the United States and Europe.
And so let's talk then about China, because that's one of the larger kind of lingering risks right now for Tesla. Is sentiment shifting so much in the region that there would be a longer term implication for how Tesla is able to operate and sell into China as well?
That's a great question. I mean, look, we see the real competition for Tesla long term. Look, we really like Rivian in the United States and in parts of Europe and other parts of North America. But in China specifically, there's some very, very good OEM competitors, some pure play EV companies. The company has one plant in China right now, able to produce about 950,000 vehicles. And they're running, despite this monthly volatility, they're running full tilt there. And we continue to believe they'll run full tilt in that country. So there's really good competition in China, but we think Tesla can operate that factory at relatively full capacity that leaves them in a good place in that country.
Tesla's energy storage business has been growing since 2015, and it hit critical mass, generating over $1 billion in revenue every quarter since Q3 22. And while this business is still only a small portion of the company's overall revenue, there is still room and growth potential here for Tesla. Tesla is in an excellent large-scale contender position to be one of the most significant growth markets of the next 2 decades. It's not just an electric vehicle company, but an energy innovator too. Even Tesla's EVs have gained global recognition, and its energy business has quietly been making waves in the industry and is expected to grow at a rapid rate. One of the driving forces behind Tesla's energy business growth is the increasing demand for renewable energy solutions. As the world becomes more environmentally conscientious, the need for sustainable power sources has never been greater. And Tesla's energy products like solar panels and energy storage all provide reliable and clean energy alternatives for residential and commercial customers. Likewise, its energy solutions like Powerwall and Powerpack are game changers too. These cutting-edge battery systems allow users to store excess energy generated from renewable sources and then use it when needed. So, with the increasing adoption of solar power, Tesla's energy storage solution offers a way to harness and utilize this energy efficiently, even during non-sunlight hours or power outages. You see, Tesla's a forward-thinking company with a good approach that's helped it to maintain its edge in the vehicle market. And as the demand for sustainable transport grows, this company is well positioned to capitalize on the shift towards clean energy. And for this reason, investors who recognize Tesla's commitment to its mission and its unconventional yet successful strategy often view the stock as a strong long-term investment. And we think this could be the very thing that every Tesla investor is thinking about.
Well, Tesla is looking to put more made-in-America batteries in its cars, but with the help of a Chinese manufacturer, according to a Bloomberg report. We have Yahoo Finance's very own Pras Subramanian to break this down for us. So, Pras, walk us through this development here.
Hey, Rachel. Yeah, so Bloomberg reporting that Tesla is kind of setting up this new battery factory or facility here with a twist, right? So it's going to be at their Giga Nevada factory near Reno. Basically, CATL, the Chinese battery maker, is going to supply them with machinery to make these batteries. And what will happen is Tesla will own the facility, they'll own the machinery, they'll employ all the workers and bear all the costs. And they're only CATL employees that'll be the ones that set up the machinery. So on paper, it looks interesting, but this is a big political hot potato. Ford had a similar issue now that with the factory in Michigan, a lot of heat from Republicans mostly.
Tesla's ambitious goals, like its plan for autonomous driving and energy storage, have all got the potential to generate significant revenue streams for the future. Already, Tesla can make electric cars at a lower cost than any other legacy car company outside of China. But that's not where the big money is. In fact, we tend to think that Tesla's biggest revenue is going to come from tech, which could make the company untouchable by its peers. Right now, this is the reality of things, and it could remain that way for the foreseeable future. Over the long haul, Tesla doesn't seem like it's going to run off the road, and it is quite obvious that the automaker still has plenty of room for growth, and while this valuation will require a near tripling in value of Tesla stock, it's still possible for investors to wait and see what happens. There's no doubt that Elon Musk and Tesla have brought EVs to the mainstream. And while there are EVs before what Tesla brought to us, it was clear that the Roadster was the one that changed the industry due to the range of its battery, speed, acceleration, and price that made it comparable to gas-powered cars. Tesla is largely responsible for bringing the electric vehicle into the public eye by introducing the Roadster as a potential option for buyers with its incredible features. And now the company's got a full lineup of interesting EVs for consumers, causing most legacy automakers to start scrambling to catch up. So what are your thoughts on this? Can Tesla still remain a solid part of the Magnificent Seven? Let us know what you think, and don't forget to leave your valuation of Tesla down below. And if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.